In 72 hours, in November 2022, $16 billion in customer funds ceased to exist. The man responsible had just testified before the United States Senate on the future of crypto regulation. He appeared on the cover of Forbes. He was worth, on paper, $26 billion. One exchange, three mechanisms. The evidence was always there. Sam Bankman-Fried, known everywhere as SBF, appeared in the crypto markets in 2019 with no exchange, no customers, and a quantitative thesis that crypto was the most inefficient market in financial history. He was right. His first company, Alameda Research, exploited price gaps between exchanges across different countries and time zones, legal, automated, and generating millions within months. He wasn't building a product. He was building a machine that found free money hiding in market inefficiency. And he was faster than anyone else at picking it up. In 2019, he launched FTX, a full crypto derivatives exchange. Within a year, it was one of the fastest growing platforms in the space. By 2021, it was processing over $10 billion in trades every single day. He had raised billions from top-tier venture firms, including Sequoia and SoftBank. He had testified before Congress. He was 29 years old. Forbes put him on their cover. Time listed him among the world's most influential people. He donated over $100 million to political causes and told the press he intended to give away virtually all of his fortune. Everyone wanted a piece of what SBF had built. Because on paper, it looked like the most successful financial operation of his generation. Higher the tower, harder the fall. And this tower had no foundation.
So where are you?
Yeah, I'm...
FTX's auditor for its international entity was Prager Metis, a firm that had never audited a company operating at this scale, and whose work would later be described in court filings as inadequate. FTX's largest reserve asset, the thing the entire balance sheet rested on, was FTT. A token FTX itself had created, issued, and controlled the supply of. And Alameda Research, SBF's trading firm operating alongside FTX, had quiet, privileged access to customer deposit accounts through what prosecutors would later describe as a secret backdoor in the system. November 2nd, 2022. A leaked balance sheet published by CoinDesk. It showed Alameda Research held approximately $5.8 billion in assets, of which $3.66 billion was FTT, the token FTX itself had issued. Meanwhile, FTX owed roughly $9 billion to customers it could not repay. 10 cents of real, liquid money for every dollar owed. That is not a liquidity problem. That is insolvency. The tower wasn't cracking. It had always been hollow. Commingled funds means customer deposits and company capital share the same accounts. No legal wall, no separation, no protection. According to court filings in United States versus Bankman Freed, FTX's systems allowed Alameda Research to draw on customer deposits without those withdrawals triggering standard accounting alerts. Prosecutors described this as a backdoor built into FTX's code. When Alameda ran trading losses, it didn't raise capital. It reached into customer accounts. This exact structure destroyed MF Global in 2011. Customer segregated funds used to cover proprietary trading losses. The crime wasn't discovered until after the collapse. The mechanism was identical. Segregated funds are the entire protection. Remove the wall, and there's nothing left but trust. And trust doesn't survive a bank run. Reflexive collateral is when the asset backing a loan only holds its value if the borrower keeps operating. The moment the borrower fails, the collateral becomes worthless, at exactly the moment you need it most. According to Reuters reporting in November 2022, approximately $10 billion of FTX customer funds had been transferred to Alameda Research. The primary collateral backing those transfers was FTT, the token FTX had issued. That token's price depended on FTX remaining solvent and operational. If FTX failed, FTT went to zero. The loan was collateralized by the very thing it was keeping alive. When Binance CEO Changpeng Zhao announced he was selling Binance's FTT holdings, citing the CoinDesk report, FTT collapsed 80% in 72 hours. The collateral evaporated before the withdrawal requests were even processed. Real collateral holds its value independent of the borrower. If the two are connected, that's not collateral. That's a story. Token inflation is when an entity creates its own digital asset, assigns it a market value based on thin trading volume, and lists it as a primary balance sheet asset, manufacturing apparent net worth out of supply it fully controls. The leaked balance sheet showed that a substantial portion of Alameda's listed assets were FTT, a token FTX had issued, a token FTX controlled the circulating supply of, a token FTX's own trading desk could directly influence the price of. In traditional finance, you cannot list as an asset something you control entirely. That's not a valuation, that's a number you chose and wrote down. When the FTT price collapsed following the CoinDesk report and Binance's sell announcement, the assets backing FTX's obligations to customers evaporated in real time. By November 11th, 2022, FTX had filed for bankruptcy. The balance sheet wasn't a snapshot of what they owned. It was a document they wrote themselves, about assets they invented. Now those three warning signs don't look like edge cases. No credible external verification of the balance sheet existed at any point. Every number the public saw was, in effect, self-reported. The FTT reserve. The entire solvency of the world's third largest crypto exchange rested on an asset whose price, FTX itself, could move. None of these were hidden. All three were in public documents before the collapse. So what do you do with this? Because these three mechanisms, commingled funds, reflexive collateral, token inflation, are not unique to crypto. They appear in every asset class. They appeared in the 2008 mortgage crisis. They appeared in the dot-com collapse. They're appearing somewhere right now. Here are the three questions to ask about any financial institution you're trusting with your money. Question 1. Who performed the external audit? And do they have a track record? No credible independent audit means no verified numbers. Full stop. Question 2. What is the collateral actually worth the day this entity stops operating? If the answer depends on the entity continuing to exist, you are unsecured. Question 3. Who has legal custody of your assets? Segregated means protected by law. Anything else is a loan you didn't agree to make. These three questions won't make you immune to fraud, but they'll make sure you're never the last one still inside when the tower falls. The three mechanisms in this story are sitting inside financial products available to ordinary investors right now, not just in crypto, not just in fraud. Which of your current accounts have you actually verified against all three of these questions? Because this story was never just about one person. It was about a pattern. And patterns like this are still sitting inside markets, companies, and financial products right now. So before you trust the next great fortune, ask yourself, who verified it? What actually supports it? And who really controls the asset underneath it? Because the people who lose the most are usually the ones who ask those questions last. We follow the money. You learn from it.